Hey guys, welcome back to another video from BetterWealth. And in today's video, we're going to talk about front loading a whole life insurance policy. Believe it or not, front loading is my favorite policy design. And I remember, Dom, the first time that I learned that this was possible, I was like, for people to understand the power of life insurance, the power of everything that it can do, and you're sitting on cash, if you're an entrepreneur, you're an investor, this policy design is a total game changer, because it gives you flexibility, but it also gives you early cash value and options in the future. And so what we're going to do is we're going to talk about what front loads are, and we're going to show you examples and go through some pros and cons. So before we jump in, Dom, what is your initial thoughts around front loading? And
Yeah, my initial thoughts are, one, when you showed me this design years ago when I was first getting into space, I was like, wow, this is actually pretty nifty. I was like, did you come up with this? I'm actually curious. Did you come up with this or did you learn it from somebody else? Because we're now innovating around it, but I'm curious where this initial concept came from.
I can't take credit for this, but to be frank, I don't know of anyone else that was doing this before we were doing it. And we actually talked to the initial insurance company that we worked with at the time, and we were talking about different examples, and they showed an example of like a little bit more up front and then dropped off the premium, but the premium stayed level. And I was like, wait a second, can we like increase that? And they were like, yeah, let's look. And so I can't take a ton of credit for this, but we for sure, after publishing our videos, a lot of people have been kind of copying, which I am a fan of, because that means people are getting better policies, whether you work with us or someone else. I love that this is becoming more common.
A front load is essentially anything that goes above and beyond years 2 on. So if my premium is $10,000 years 2 on, anything above $10,000 in that first year will be essentially considered a front load. And we're going to show you 3 examples what a front load will look like. And the reason why we like front loads is because
you get a lot of early cash value. If you understand the value of life insurance, you want as much of your money in what's called cash value, which is the cash available in life insurance because of all the benefits. And so overall, it allows you to have that without giving you a large contribution that you have to hit every single year. So you kind of get your cake and eat it too. You get the benefit of life insurance, early liquidity, but you don't have large base contributions, required contributions ongoing. And so it's the best of both worlds.
if you are not getting a return on your dollars, if it's essentially getting 0% in the bank account, well, actually now with the rising interest rates, 2, 3%, whatever it looks like at the current moment in time, depending on when you're watching this video, this can be a valuable tool for you to get your dollars to work for you faster. And so I'm also going to share with you why some companies actually perform really well and some companies really don't, because there's some advantages depending on the company. Like Caleb was actually saying at the beginning, he may have worked with a company that was showing the specific design. They didn't even know what was possible. And then you work with another company and they know it's possible, but they intentionally make it disadvantageous because they don't want you to do so. Why do they not want you to do so? Is because they understand that people that want to do front loads, they're likely going to be able to use that cash earlier on. There's a lot of companies that really want to hold on to that control of that cash and not have you take policy loans against it.
Yeah, there's only about 3 or 4 companies that even allow you to do this style of policy. And so with that, we're going to jump into the numbers. And Dom, I'll let you take it from here.
Amazing. So we're going to look at 3 different designs. They're going to start off small and then they're going to get larger and larger. And so the first design we're going to look at is a $50,000 front load, first year contribution. After that, it's going to be $20,000 going forward, therefore after. So when we put in $50,000, you'll see that we have well over 90% liquidity within that first year. So this first year, there's almost $46,000 of cash value and $826,000 of a death benefit. The break-even point, which we always like to talk about, happens in year 5, where you have more cash value than the money you contributed, which there's $130,172 within that 5th year.
And then what is the actual base or required contribution?
So the base on this policy is actually 15%. Okay, so it's 15 base, 85% PUA. And so when we're looking at that, that's a $3,000 contribution that you're required to contribute after the first year.
So I want to put this in perspective. We're showing someone putting $50,000 in the first year and you have over 90% cash available. And then ongoing, your actual contribution, your actual base contribution is $3,000. So we are essentially hyper funding a $3,000 policy to give you early liquidity and a lot of different benefits. And that's why I'm a big fan, is if you might be sitting on some money, but you don't know what the future holds, you would like the ability to save $20,000 a year. But if you can't, we want to give you all the options and flexibility to figure out different ways to either fund the 3 out of pocket or figure out how you can take some of your cash value and fund the base contribution.
Yeah, and this one is cool, but the next two actually, in my opinion, are even sexier, and I will show you exactly why. So if we look at the second option, we're contributing a little bit more in the first year of front load. So instead of being $50,000, there's $100,000 in the first year, and then it's a $30,000 contribution therefore after. So if you look at the cash value perspective of the amount of liquidity you have, it's really easy to do the math with 100,000. There's 93.4% liquidity in the first year, which is insane amount when you look at typical whole life, because typical whole life, you have 0% in the first year. And now we're looking at a policy where you have access to almost 94% of liquidity to be able to borrow against to use for another activity, hopefully an asset producing activity if you follow the movement of the and asset. And when we look at this, the break even point is at year 4. Wow. Now, I personally, if you're not 1035ing a policy, which is essentially taking cash from one company to another company, I have not seen a policy be able to break even any earlier for at least a consumer. There are other policies like BOLI and things like that, bank-owned life insurance, where you could accomplish it. But when we're looking at specifically for a consumer or a business owner, breaking even in year 4 is as early as I've ever seen a company allow that to happen, which is insane when we're looking at actual control, when we're looking at whole life insurance.
Yeah, and just for you, if this is the first time you're watching a video of ours, break even means you have more cash available than what you've put in. It really is one of those metrics that I think more people like talk about, and it doesn't necessarily translate to value, but it's like if you're going to cancel your policy, you actually have more money than what you've put in, and it's a good way to compare apples to apples when you're looking at other policies. What is the actual base on this The
base on this one is 20%. And so there's two things that I'm wanting to mention with kind of what we're looking at. So the first thing is that there is a term rider that's inserted into these policies, okay? And when you're looking at most whole life insurance contracts, if you are doing a cash flow strategy, which is there's no front load. So in this one, if it was $30,000, therefore after, if you did like a 10-year term rider, likely would only allow you to pay into it for 10 years. This one has a 10-year term rider as well. As you can see in the 10th year, the contribution goes from $30,000 to $29,452. And also, if you look at the death benefit, it goes from $2.2 million to $1,066,000. And the reason that is because that term rider that's inside of the contract essentially falls off. But the really cool part about this is term insurance is essentially a cost with this company. Now, every company is going to be slightly different. Some companies will allow you to buy PUA with that term rider, but this company specific, the term insurance is 100% just a cost. But because we're putting in so much money up front, that PUA is going in so fast that we're able to do a very short term rider and to be able to allow yourself to keep paying this longer than 10 years, which is essentially another amazing benefit, because now we have a cheaper policy from an expense standpoint, and you can still pay into the policy extremely long to allow you to still have the benefits of life insurance.
Yeah.
And then the other thing when it comes to the base, I would say this is a slight disadvantage when we're doing dump-ins, is when we're having a large dump in, and we're looking at the ongoing payment, if the front load and the ongoing payment are too small away from each other, so essentially, that's a $70,000 difference between the $100,000 and the $30,000. If those become too far apart from each other, the insurance company is going to ask you to increase the base on the policy. That doesn't essentially make it less efficient because we're putting in so much cash up front, but what that essentially does is it makes it slightly less flexible for you in regards to the ongoing contributions.
And an extreme example of this is if you were to put $1 million of cash like upfront into a policy, and then you were like, hey, I want to put $10,000 a year after, there's no way that we could do that and for it not to be a mech. Now, we'll have other videos about the pros and cons of actually meching a policy. I think there are some benefits to meching a policy, but overall, if you want it to not become a mech, meaning you want it to get all the tax benefits of actually being insurance, that what you're saying is the base has some ratio. Every company's a little different. And so if we put a huge front load, in a lot of cases, it requires us to put more money ongoing, and that base has to hit a certain minimum.
Yeah, and it comes down to what the IRS is saying, because like Caleb said, the insurance company will allow you to do 50x the base to be able to put in for PUA plus. But the IRS, if you want to have those tax advantages that life insurance has, then you have to stay within the limitations of what the IRS will allow.
So is it fair to say that this is a $6,000 policy that we're putting $100,000 in a year and giving someone the ability to put up to $30,000 for the first year 2 through 10?
Yeah, it's literally amazing. If you were someone that had $100,000 that's sitting in the bank doing absolutely nothing for you, and you're like, hey, I want to start a policy, but I may be able to save $6,000 and I may be able to save all the way up to 30 grand. This is exactly what that is, which is insane when you think about it.
What I love again about this is when we talk about landing the plane, you have $93,000 of cash value, unless you're leveraging all that money, which we'll go on record and saying like, we don't recommend people taking a safe asset and leveraging 100% of it. It just, we've have clients that do that. And we just, again, love there to be some buffer. So if you didn't leverage all your money out, and we have plenty of videos that talk about the benefits of borrowing against and how people do that, you have enough cash value easily to do what's called landing the plane and at least come up with a year's worth of base contribution, even if you couldn't go out of pocket. But for a lot of people, $6,000 out of pocket would not break the bank in a policy design like this.
Yeah, and this company specifically, they really are designed for the flexibility to do these types of front loads. Like I've never seen another company in the entire space that this company allows that to happen. I've actually had conversations with other people in the other space with other companies where they intentionally make your base really high and you make your policy less efficient when you have less cash value. Yep. So they push you away from doing that. And this company is big into like infinite banking. They have seminars around it. A lot of the top producers are infinite bankers. And so they understand their audience, which is, I think, is important. And then there's other companies that understand their audience, their target market. And they would say, we actually don't want that business. And therefore they make it very hard or disadvantageous for you to do that. So all of these rules that Caleb and I are talking about are company specific. Yep. And this company just allows us to be extremely sexy.
And one of the things that we're pretty clear on, it is unless we're giving like an update on company to company that year, we're just going to keep the companies anonymous because every company could change year to year on their new products. And so we want this to be as evergreen as possible. And for the last 5 to 6 years in business, front loads do exist. Now, how they work year to year could change based on new regulations and interest rates. So we're going to go to the third and final illustration for this example. And this looks like we're putting $300,000 in year one.
$300,000 in year one. And just know that $300,000 like isn't the limitation. Like if you were somebody that had like $1 million and you wanted to throw that in and then you were like, hey, I want to do $100,000 therefore after, that is also very possible. It just really has to make sure that the ratio between the two isn't too far apart. And this one is only 6x the difference between 50,000 to 300,000. So it's really not that far off. And what we can do is we can just design it in a specific way that fits your needs based off of how much you want to contribute year one versus how much you want to contribute therefore after. And when we're looking at the liquidity, I think you might have done the calculation.
I can't help myself. 94% first year liquidity. And this is not a MEC, meaning it's when set up and used properly, you can borrow against your policy, income tax free, your money grows tax deferred, and it still gets passed on income tax free. Like that's unbelievable, Dom. 94% first year cash value, not making a policy.
It is absolutely insane. And that's why I actually love MECs. And when you start to look at the break-even point on this policy, it happens between years 3 and 4, which is insane. You have 396,000 of the 400 you put in year 3, and then 458 in year 4. The thing that I really like about this is when you look at insurance, you start to look at like actual cash flow and dollars that you put in and how much do you get back. I actually think that's a really cool metric to look at. And in this policy specifically, when you put in 50 grand in year 2, your policy increases by $55,000. So you essentially put in 50 and you made almost 6 grand. That happens in year 2. When you start looking at cash flow, like that is absolutely incredible. And it doesn't happen really on any other policy unless you're front loading it, and with this company specifically as well. The disadvantage again, this policy specifically, the base is now 30% versus 15% in the other one. The reason being is it has to, because we're starting to get really far away from each other in regards to the 350,000, but that's still only a $15,000 base requirement to contribute. And to give you the ability to do $50,000 of your ceiling is absolutely incredible. And we have $282,000 of cash value in year 1 if we somehow couldn't pay our base premium in year 2, which gives you maximum flexibility, in my opinion, by throwing in a ton of money and having the ability to pay using your premium if needed to. So I don't get too concerned about increasing the base, because typically when we talk about increasing the base, it makes it less efficient. But in this instance, you can see the policy broke even earlier and we had more cash value earlier. So increasing the base actually was a win in this situation.
Oh, and if you wanted to actually put more money in, like let's say you want to put 300,000 and then maybe 75, then increasing the base actually gives you the ability to save more, which you could easily argue in the long run is better long term because you're now comparing oranges to apples. So it's not as black and white, but what we want to do is give you different examples, because what I love about this is like, if you understand the power of the and asset and giving your dollars more than one job and like protecting yourself, growing your money, controlling it, giving yourself options in the future, it's pretty incredible. Like one of the biggest problems in life insurance is like early liquidity. This kind of eliminates early liquidity pretty much right in year one, because majority, like if you put your money in 401ks and other things, you don't even have access to it. So unless we're dealing with a savings account, which would be ahead in the first couple of years, but the savings account doesn't have a death benefit, savings account doesn't have all the other benefits of life insurance, and this pretty quickly outperforms the savings account and gives you all the other benefits. And so if you started doing like a pros and cons, the pro would be in the first couple of years would be slightly ahead. The cons or the pros on the life insurance side would just trounce this long term.
Yeah. And, if you start looking at it from the con perspective, when would you ever use 100% of your dollars? Like even in your bank account, like I think that's a very risky thing to do.
That's fair. That's very fair.
And you're still going to need term insurance to cover yourself for the death benefit that you're provided here. So in reality, like, yes, that is a con. But when you start to compare and look at the other advantages, like you said, that you get tax advantages in this policy as well that you don't get in a savings account. But one thing that I would like to add when we're looking at these is something to consider is that your income that you make is actually an important indicator of how much insurance that we can get on you as a human. You may be a great saver and had $1 million saved up, but if your income was only $20,000 a year, it would be really hard to justify a policy like this, because they are going to underwrite you for amount of death benefit that you're worth as a human being that they're going to deem worthwhile. And so to know that exact metric of like what your human life value is, what the insurance company will insure you for, you would essentially have to come and sit down with us for us to ask you some questions about age, income, net worth, for to find out to see what is possible for you to contribute to these policies. And that also comes to the annual contribution after that as well, because there are some limitations around how much you can contribute thereafter based on your income as well.
Yep. I think that was super well said. And not that this is a pitch to talk to us, but literally, if this is something that you're like, I want to learn more, that's exactly what we do. And that's why we make videos, is to educate, make you aware, but also know that your situation is different. You're probably not 36 years old, whatever the health rating is, with $300,000. Like, you may be a little bit of a different human being. And so seeing your custom numbers is key. And also talking about just different examples, because there's pros and cons with front loading versus what we call the cash flow style policy. One's not all better than the other. It's just one of those, if you have a ton of cash up front and you get the benefit of life insurance, front loading in many cases makes sense.
Love it.